3 more rate cuts in 2025? That's what this $1 trillion fund manager is expecting. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. My name's Bryce, and with my co-host Ren, today we're looking at why so many investors are underweight fixed income and why now might be the time to change that. Ren, good to be with you.
Bryce, good to be with you as well, and excited to be joined by Rob Mead, who is a Managing Director and Co-Head of Asia Pacific Portfolio Management at PIMCO, one of the world's largest investment managers with trillions of dollars under management.
In today's episode, we are going to be chatting to Rob about the history of PIMCO and more broadly the fixed income market, but then digging into their views of the macro landscape and all the uncertainty that is currently playing out in markets, and closing out with the age-old debate between active and passive and how advisors should be thinking about that.
Yeah, it's a funny one because in the equity markets, we're very familiar with this whole active v passive debate, and there's a growing body of evidence around how hard it is for active managers to consistently outperform the market. And we look at S&P Global's SPIVA scorecard, and you sort of see that over the last 10 years, it's something like 15 to 20% of Australian active management has outperformed the benchmark. But the story is different in fixed income, as Rob explains, where active management does consistently and repeatably outperform the benchmark.
Yeah.
So it's interesting to get, the other side of the debate in another asset class. But the debate will go on forevermore, I'm sure.
It absolutely will. Now, a huge thank you to our launch partners, SIBO, Milford, and Orbis Investments. But a special thanks today goes to SIBO.
Did you know that Australia has more than one stock exchange? You might have traded on SIBO without even realising it. With approximately 40% of all Australian ETF trading happening on SIBO, they understand the growing interest in ETFs among Australian investors.
And today, as we've said, we are chatting to PIMCO, one of the fund managers that are listing their range of ETFs through SIBO.
It's the support of partners like SIBO that allow us to keep Basis Points content free and accessible. So a massive thank you for their support.
And a reminder that all our episodes are accredited by the FAAA and do count towards CPD points. So if you're listening and want to take advantage of that, there'll be a link in the show notes or the description below to get those CPD points.
All right, Bryce. Well, with that said, let's get to our conversation with Rob Mead.
Well, Rob, welcome to Basis Points.
Great to be here.
So PIMCO has had a long history here in Australia, having opened the first office back something like 25 years ago.
Yeah.
But for those unfamiliar, can you give us an introduction to PIMCO?
I've been with PIMCO over 20 years as well. Sort of the history of PIMCO was it was a sort of very traditional active core bond manager, and over those past couple of decades it's evolved into quantitative, to private credit, to public credit, all sorts of different alternatives, hedge funds, that sort of thing. So it's been a journey, but an active bond manager underneath all of those additions.
Nice.
And one of the biggest globally, like for people who are unfamiliar with the name PIMCO, in the institutional world, it's very well known, I think is fair to say.
Yeah, absolutely. And again, we've run funds here as well. So the instos are obviously a very large part of PIMCO's business globally, but we're also sort of very big in the retail markets, both in Australia, even in Europe and the UK, and very much so in the US mutual fund market. So that was sort of part of the initial incarnations of PIMCO, was sort of very high profile as a mutual fund manager. And we launched our fund complex here over 20 years ago too. So it's hopefully becomes more and more known in the retail space as we go forward.
Now, a challenge for PIMCO in the past, call it a bit over a decade, has been fixed interest has been somewhat unloved, really, in the post 2008, falling rate environment, QE environment. Fixed interest probably became a smaller part of a lot of investors' portfolios.
Yeah.
But make the case for fixed interest. Things might be turning in the world, so make the case for us today.
Yeah, so it's a fair comment, and it's for me is to have built a career path in the bond market in Australia, which is arguably the most risk-on investor base in the world, the lowest allocation to bonds virtually versus any other country. So it has been a tough couple of years, at least, or maybe a tough sort of decade, but things have changed a lot. right? So back in 08, 09, and then again through the pandemic, rates were down to zero or very close to zero. Now they've normalized. So one of the great things about bond investing is almost 95% of the expected return in a bond, it's about high quality bond, high quality credit, 95% of the return is explained by the starting yield over the following 5 years. So starting yields right now are high. Bond funds are generating sort of 5, 6, 7% in terms of their expected returns over that period. So investors should feel very positive about adding bonds to portfolios if they're currently underrepresented, because those yield expectations are good and lots of other asset classes look pretty fully priced. So on a relative basis, on an absolute basis, if you're not owning bonds now, you should be adding.
Yeah.
Nice. Okay. So, Rob, you've been in the industry for or at PIMCO for 20 years. How have you seen the Australian fixed income market change over that period of time?
Yeah, it's a great point. Early on in my career, there was discussions from the Commonwealth government about whether or not they even needed a bond market.
Wow.
The
Really?
surpluses, yeah.
Wow.
The budgets were in surplus.
Gee, must be nice.
A lot's changed over that time, hasn't it?
So as far as the eye could see, it was surpluses. And then so through the Costello, through when he was treasurer, there was literally discussions, do we really need a bond market?
Wow.
And so 20 years on or so, obviously there's been issuing more and more bonds ever since. And with the budget this week, there's obviously deficits as far as the eye can see. Not big ones, not like places like the US, but deficits nonetheless. So the bond market's changed a lot. The other thing is that the corporate bond space in Australia has become incredibly vibrant. It used to be quiet and sort of a irregular issuance. Now there's literally deals every day. The structured market, RMBS and other things, again, RMBS market in Australia is now the second biggest. Well, issuance last year put it as the second biggest in the world after the US. So there's so much happening. The final episode or the final chapter for some of those things is the hybrid market's now disappearing, needs to be replaced somewhere. So part of that will definitely be replaced in the bond market directly.
Well, let's turn to, I guess, the world as it is today, and I guess the sort of the macro outlook. And PIMCO recently published a paper where you claimed that uncertainty is certain. And I think if we think about what's happened so far in 2025, uncertainty is maybe even underselling it. So can you elaborate on, I guess, how you see the market today and why you think uncertainty is the name of the game?
The media is driven by headlines every day.
Yeah.
Some of the things about that uncertainty being certain relates to the changes in trade policy, the changes in geopolitics, the changes in alliances around the world, and the way that's being communicated. So there's definitely a lot of noise. For an active manager, that's a good thing. We like noise, we like volatility, but it's also very important for end investors to be thinking about different potential states of the world when they build portfolios. And so that's really the messaging around uncertainty being certain, is that as long as you've taken that into account in terms of your investment outlook, then it can be a huge opportunity. But just assuming that it's more business as usual that we've got used to over previous cycles, I think that would be a terrible investment mistake. You need to really think that through. So when you look at things like trade policy, uncertainty indices, they're like a straight line up, just going straight up. There's so much uncertainty. Again, we'll get some more clarity, at least to some degree, around the tariff backdrop. But even that's not going to be stable. There'll be constant changes there.
Yeah.
So again, I guess build your portfolios for some resilience, because there's more noise coming.
If we drill down on here in Australia, how do you feel like we're currently positioned? And what does 2025 have in store for us as Aussie investors?
I guess we're now in a phase where the RBA's engaged. Obviously one cut so far. That's a reflection of a few different things. First thing is inflation's coming back down. It's coming back down slowly, I admit that, but it's coming back down nonetheless. If you annualize the most recent inflation prints on a core level, we're bang in the middle of the RBA's target. So things are there ready for more policy action. And then if you strip out the government sector from the economy, we're already on the cusp of recession. Like, things are pretty tough. We need some more policy support. Employment is getting looser. Like, there's been this fear that employment markets are very tight, but that's loosening. So all of these things are aligning, in our view, for RBA to re-engage. It's not just one and done. That's just not accurate. We think there's probably another 3 cuts coming this calendar year.
Wow.
It's a little bit more than the market thinks, but we think it's necessary to provide some stability to economic outcomes, especially with all of this volatility being induced from some of these trade policy decisions.
And you think that's the case even after the recent commentary from the RBA, just saying, we've done it, back away.
Yeah, leave us alone.
Leave us alone.
Yeah, it's so I guess the RBA, and I have a huge amount of respect for the governor and everyone else in the RBA. So it's not a commentary about the individuals. They're incredibly talented and smart people. But I don't think it's worthwhile getting caught up on what the market's saying. The market has a job too. And our job is to preempt what we think is going to happen and position our portfolios for our clients on our view. And so there's no reason to get hung up on what the market thinks, is my take. But that said, remember the RBA was suggesting back in November that things were a long way away, yet we get to February and there's a move.
Yeah.
Right? So I wouldn't read too much into that. One of the things that the RBA is very cautious around is forward guidance because of mistakes or misinterpretations, I'd say, from previous governors that were sort of taken as gospel, and that they would just sort of try to provide some helpful guidance. So irrespective of what the rhetoric from the RBA, we still think the economy will justify additional cuts.
So, like, people will like the idea of additional cuts, especially if they own Australian property. But I guess what we should understand fully is your view is that comes from like an underlying weakness in the Australian economy.
Yes. Yeah. So again, if you strip out the government sector, so the government sector's been hiring, it's been spending. Obviously, we're running small deficits, which are stimulatory. If you strip that out, then the economy's barely growing.
Yeah.
So the one element that's been, obviously, and it will continue to be a really important indicator, is inflation. And if inflation doesn't keep tracking down towards the RBA's 2 to 3% band, then PIMCO will be wrong. They won't cut rates. But we think all of the evidence suggests that the stickiness of inflation is coming down. Yeah. There's more and more friction in the ability for economies to keep growing. Obviously, trade and sort of globalization has been a huge tailwind for global growth, and some of those things are going to slow at the margin. So we do think monetary policy right now is restrictive, needs to start to move further back towards some sort of normal, or some sort of neutral, I should say.
And if you broaden it out to the world again, and maybe just if we look at the US, how do you think about their levels of rates? And obviously they've got the dual challenge of the economy might be slowing, but inflation might be rising with tariffs. So how do you look at the US at the moment?
Well, the US started cutting a lot earlier, and so they've moved rates like 3 or 4 times, and starting with a 50, right? So they're closer to a position where the Fed has the ability to wait, because they have acted. So other countries like New Zealand's have cut 175 basis points. They've done a lot too. We've only done 1. So I think we've still got more to do. I'd argue that the Fed is closer to, maybe there's 1 or 2 cuts remaining this year. But because it's so noisy in the US, expect the Fed to be very patient, very cautious. But if growth starts to slow, if unemployment starts to rise, expect the Fed to re-engage.
Now, Rob, we want to drill down on a little bit more around the reasons to invest in bonds. There's a recent article from PIMCO outlining 7 reasons why now is a good time to invest in core bonds. So can you elaborate on that and how you came to pick 7?
How did we end up with 7? Arguably, we could have had more, but I thought 7's going to work better, just given what's been happening in markets over the past couple of years. And while it's a bit tongue in cheek in terms of the characterization, it's a heartfelt view that is valid, right? And it's not just a marketing marketing initiative. So uncertainty is certain, which means portfolios should be diversified. Like, it's not the time to back one particular investment with a high degree of confidence because things are uncertain. We also touched on yields are still high, right? So when yields are high, and as we talked about, it's like for years and years they weren't high. And so now they're high, 4, 5, 6, 7% for very high quality instruments. Diversification becomes even more of a no-brainer. One of the other reasons is, why do you diversify in a portfolio in the first place? You diversify because not all assets are perfectly correlated, right? You want to have either low levels of correlation or negative correlation in a portfolio in order to improve the risk-adjusted return, right? So you end up with higher return for lower risk. It's the one free lunch in investing. So when you think about what those sort of correlation properties have looked like historically, it's true that all assets became quite correlated, or at least positively correlated, when inflation was way above central bank targets. Because the most important driver of asset class returns was inflation. And if you look at history, when inflation comes back down into the target range, correlations go negative. And so we're moving into that phase right now where the power of portfolio diversification is returning. And so investors shouldn't ignore that. Like, it's something that, don't dismiss correlations based on a historical episode that's not being repeated. Think about where we're going rather than where we've been. Some other things that are clearly sort of driving those 7 as well is equities are expensive. And so they're less expensive than they were when we wrote that piece, because markets have started to correct already. When we first published, they'd barely moved. They were still near highs, so there's some of that correction happening. But even if you're looking at PE ratios right now, they're still elevated, and suggesting that there's room for some disappointment broadly across global equity markets. Again, we're not talking about crashes, we're just talking about relative expected returns. Like, if you don't think equities can generate low double digits and you think bonds can generate mid to high single digits, then you shouldn't be 100% in one and nothing in the other. Final thing I'll say, and we can talk about some of the other of the 7 as well, is the hybrid market's disappearing. And so we know that they'll slowly get called, and investors need to replace that income in portfolios in some way. The really important thing about why hybrids were so popular, it was not because they were so risky. It was nothing to do with that. It was because they had franking credits. And so you don't want to replace a franking credit only with a really illiquid, say, private credit option. That should form part of the replacement, but not all of the replacement, because you don't want to replace franking with just risk. So that's when other core bonds, other high quality income opportunities become just a really compelling addition to investors' portfolios to replace that income stream that hybrids were providing historically.
Nice.
So Rob, I think you've done a great job of covering most of the 7 reasons, and just to recap some of them, core bond yields are high, developed market inflation is falling, cash rates are falling as a result, and equities are expensive. One that we didn't touch on, but I'd love to get a bit more colour on, is how defaults and restructurings are accelerating. So there's people have probably seen a little bit in the media around that, but can you just give us some colour on that and why that leads to fixed income being a good investment?
One of the most important disciplines of any form of bond investing, it can be in the private space or the public space, is to think about your returns after losses. So the more credit risk you take as you go down credit curve, the higher probability of some losses in a portfolio. So you want to look at sort of loss-adjusted spreads. You don't think about just assuming that everything is money good. The more risk you take, some things it won't work out. And that's okay. There's nothing wrong with that. That's just you're getting paid a much higher return to compensate you for the probability of things don't go well. Yeah. And you're starting to see that very starkly in a couple of different sectors of the Australian economy. So you're seeing that in property development, and you're also seeing that in parts of hospitality. And so having too much concentration in those two sectors, we think is not a great thing to do. Thinking about other areas where you can deploy capital with similar expected yields, but much lower expected losses. And some of those opportunities are outside of Australia. So I think it's just one of those things because there's no really deep high yield market in Australia. There's no sort of tradable bank loan market in Australia where there is in the US. You get your first leading indicator in those markets in the public space because things start to default, the delinquencies go up. In Australia, it's almost all private.
Yeah.
So there's just not as much visibility on stresses that are materialising. And again, it's just a matter of being aware of that as an investor, being a little cautious, not abandoning the area completely because there's plenty of great managers in that space. There's plenty of great opportunities, but just don't be too concentrated.
So with 7 magnificent reasons to invest in core bonds, the question is then how to determine which strategy. And with a variety of core fixed income strategies available, global versus Australia, how should an advisor incorporate fixed income into a portfolio and think through the various options?
Yeah, so there's sort of 2 really key things to think about. First is, do you want to be solely invested in Australia, or do you want to think more globally? And so the idea for PIMCO, and we've had these funds available for a very long time, and now they're available in ETF form to fit a different cohort of investor base, is to sort of think through that. Do you have enough global diversification in your broader portfolio? How do you think different bond markets around the world are likely to perform? So having a choice between those 2. Second thing is we provide a pretty simple solution just to bolt the 2 together. So if you don't want to make that active decision as the end investor, you can buy a 50-50 version of Australian high quality and global high quality. And then in ETF form, we've also launched a high quality global credit variation. Global credit all hedged back to Australian dollars. So it really comes down to how they fit in a portfolio context, which is, because I don't have that visibility, it's hard to give very clear guidance. But there's a sort of courses for all the different particular solutions. In all of the cases, the yields in those opportunities are somewhere between sort of 5 and high 6s. And then we will launch additional ETFs in that space going forward as well.
Well, Rob, we want to take a quick break here. On the other side, we're going to get into the eternal debate when it comes to investing, active versus passive. But before then, we want to take a break and say a quick thank you to PIMCO.
For over 50 years, PIMCO has been at the forefront of fixed income investing, blending deep market expertise with innovative strategies. With their rich history in ETFs, having been one of the first managers to list an active bond ETF in the US back in 2008, they continue to focus on delivering innovative solutions for investors around the world.
PIMCO's new ETF range offers Australian investors access to the same portfolio management teams, time-tested investment processes, and in-house research that have helped it become an industry leader, delivering strong outcomes for clients over decades and across every different market environment.
To learn more about PIMCO and their new range of ETFs, head to their website, pimco.com/au, and we'll put a link in the show notes.
So thank you to PIMCO for helping us make Basis Points possible and helping us keep all of our content free. All right, Rob, I teased it before the break. We're going to get into the eternal debate that a lot of people are probably familiar with on the equity side. Maybe people are less familiar with the debate and the arguments on each side in fixed income. But active versus passive, where do we start with the debate? And PIMCO is an active manager, so why should we be thinking active?
Yeah, it's a very good question. It's something we've been getting for a couple of decades at
I'm
least.
sure.
So I guess there's a couple of things. Firstly, and many of the listeners and viewers may not even realise this, but if you look at the history of active equity management versus active bond management, the bond manager universe of active managers has been way more successful in repeatable alpha generation versus passive. So does that mean it's easier to manage bonds? Maybe. Could be. I'll say no to that, but it could be that. Or is it just that the equity market's more efficient and there's less opportunity? It could be part of that.
There's a third answer that you should be arguing, which is that bond managers are smarter than equity managers.
I won't comment on that.
I'll take that.
But that's the reality. If you look at history, that differential's been consistent. And so, not surprisingly, more sort of equity investors have gone passive because after fees you were not getting paid for not all some active managers, obviously exceptional, but many in history weren't. The other thing is that when markets are volatile, it's much more conducive to active management. When volatility's constrained, especially when central banks were holding rates down, you had all these sort of concepts of like a put sort of thing where the central banks would provide support for all markets. Inflation was low. All these sort of things suggested it was much harder to generate alpha. And when things become much more volatile and there's a lot of noise, the sweet spot for alpha generation sort of comes into its own. So not only do we think that the bond asset class is very conducive to generating alpha, we're also in an environment that's even more sort of pound the table in terms of that active versus passive opportunity set.
You said earlier that uncertainty is certain. So can you give us a sense of how active is operating today? Like how are PIMCO managers responding to this sort of market environment?
When the market's in a sort of crisis phase, or when we went into sort of even a pandemic phase, the correlation and the synchronization of global economies is almost perfectly aligned. Everyone's doing the same thing to prevent the crisis worsening. Now we're in a phase where economies around the world are completely desynchronized. We've got policies that are helping one part of the world and damaging other parts of the world. Like there's not everyone a winner or everyone a loser. So for an active manager, identifying the winners and losers, identifying how to invest in the various subcomponents of the bond market for those environments, being cautious around companies or economies or even governments that may be susceptible to some of these policy shifts. All of these things provide ample opportunity to reposition portfolios and do it much more frequently. So if things take months, weeks, quarters, or like even years to play out in a market sense, then as an active manager, it's harder to position. When things are moving around every day, then if you've got a very robust investment process, you've got some anchors in terms of where you think markets are going, you can fade those moves literally every day. And so that's what we're doing. The nice thing about a bond manager is there's so many dimensions for that. It's not just overweight or underweight interest rates. There's a whole yield curve in every single global market. There's different parts of the credit spectrum. There's different currencies to be trading. And there's also one of the things we're very active in is trading volatility. So if volatility is providing a way to sort of position portfolios and get paid for the volatility, when it's high vol, they can be very rewarding positions in a portfolio sense.
Yeah. Well, let's turn to these new active ETFs that have launched in Australia. You started with 4. You didn't want to do anything in half measures.
Just bang.
So why was now the time to launch, and give us a sense of what you have started with here?
Yeah, so I think it comes back to that Magnificent Seven in terms of why now, right? So I think the planets have aligned in terms of why we think the ETFs and the funds that we've managed for an extended period that sit behind the ETFs why now is a great time for portfolios to be diversified and investors at the end of the decision making process to start to really think about that now. So the ETFs are backed by funds that have existed for an extended period, as I mentioned, but they haven't been available in a listed format where they could be traded intraday. And so this is a huge leap forward in terms of the availability of active PIMCO funds on an actively traded platform. That's an opportunity that we're providing to the market that we haven't before. As you mentioned, 4 funds, really the flagships in terms of providing that access to Australia, to global, a diversified version of those, plus some very high quality credit. As we also had a quick chat about, we will bring more to market. We think those are the 4 to launch with that provide most of the solutions that investors are looking for. But as things evolve, we will add some additional ones to provide a little bit more bespoke versions of the asset class.
So Rob, the 4 that have launched, you've got the Australian Bonds Active, the ticker is PAUS. You've got the Global Bonds Active, PGBF. The Global Credit Active, PCRD, and the Diversified Fixed Interest Active, PDFI. So Rob, these funds have been in operation long before listing on the exchange. In fact, the inception date for the Global Bond Fund is July 1998. Can you give us a sense of their history and performance to date?
It's an evolution of the availability or the ability, I should say, to have active ETFs of a fund. We probably would have launched them a lot earlier if it was capable of doing that before, but it's a great evolution of the exchange structures to make them available in this listed form. So PIMCO's been around 50 years. So when you think about these funds being around for sort of 25-ish years, it's only half the history of PIMCO. But it was something we decided to launch for the Australian client base an extended period ago. And there weren't that many opportunities available for Australian investors to truly diversify across global bond markets at that time. And they've done really well. And so the great thing is of having a fund that sits behind the ETF, all investors can observe the track records, they can observe the process that's been applied, they can get to know the portfolio managers that have been involved. So it's a really good proof statement in terms of the credibility and the alpha generation over that very long period.
So for retail investors, they now have access to all these ETFs, which is great for accessibility. But for a number of advisors, they could already access some of these funds through platform. So how do you think about advisors making the choice between now going the ETF route or the managed fund route? Do you have any suggestions on how they think about that?
Well, the great news is you're getting access to exactly the same investment. It really comes down to the preference of the advisor to want to invest in fund form or in listed form. And so the investor experience will be the same because you're investing into the same underlying. It's just whether or not you prefer to be in listed form or unlisted. The other thing to mention is these funds have all been very successful. They're all sort of multiple billions of dollars invested by Australian investors into the funds already. So advisors have been huge supporters of the fund versions for literally decades, as we mentioned. This just provides a different access point for any advisors or end clients, for that matter, that prefer to have the listed version.
Well, Rob, that brings us to the end of today's podcast. We thank you so much for coming in. Thank you, PIMCO, for the support of today's episode, and SIBO. Congrats on the launch of the new ETFs. Looking forward to seeing the next iteration of what comes. But it was great to chat.
Absolute pleasure. Thanks so much.
Now, if you've enjoyed this episode of Basis Points, make sure you subscribe wherever you're watching or listening so you don't miss a future episode. And if you want more from us, make sure you sign up to the Basis Points email. The link is in the YouTube description or the show notes. For advisors, make sure you claim the CPD points for listening to this episode. All episodes are accredited by the FAAA. Head to the link in the YouTube description or the show notes, complete the quiz, and we'll send you your certificate. And finally, a massive thank you to SIBO for sponsoring this episode, being one of our launch partners here at Basis Points and helping us keep all of our content free. If you want to learn more about SIBO or any of the fund managers that list on their exchange, including PIMCO, head to the link in the show notes.